Thanks for clicking. Canadians are continuing to spend despite the 425 basis points in rate hikes that we've seen over the past year. This according to two new reports coming from the Bank of Montreal and RBC. Or, more specifically, some Canadians are continuing to spend.
I need all of their numbers. Home, sell, everything, yeah.
Indeed, while the interest rate hikes that we've seen over the past year have definitely cooled the housing market, the reports coming from BMO and RBC show that the rate hikes have failed to dissuade a large portion of Canadians from spending and could prove to be a big problem for the Bank of Canada. While inflation has slowed to 5.9%, it is still far too high, and as these reports show, could remain sticky well into 2023. So what I want to do today is go over the reports from BMO and RBC, take a look at some of the implications for the Bank of Canada, and then discuss what to look for next. Speaking of next, the end of the month is on Tuesday, and we're expecting to get February's real estate data out from the local board soon thereafter. We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these reports. Onto the reports. The first report, published by the Bank of Montreal, found that despite the increase in interest rates over the past year, Canadians have still amassed $340 billion worth of excess savings. In fact, BMO found that Canadians have a 5.7% savings rate, well above the pre-pandemic average of 2.2%. Yet the excess savings, as you might expect, is not dispersed evenly. The rising cost of necessities like food, gas, etc. has taken its toll on low-income earners, with the bottom 40% seeing their net savings shrink by 12% between 2020 and late 2022. Indeed, Stats Canada just recently published a study showing that 1 in 4 Canadians couldn't withstand a $500 unexpected expense.
Lexus fees, the Xeroxing.
So, according to the report, the lowest income earners saw their savings rate drop by 12%. Meanwhile, the report notes that the second highest income quintile saw a 34% increase in their savings and a 21% advance in savings for the top income group. So, according to this report, lower income groups have seen their savings drop substantially, the higher income groups have seen their savings advance. News at 11. And Canadians have amassed over $340 billion in excess savings over the past few years. And according to the report from RBC, Canadians have failed to slow down the spending, due at least in part to these excess savings. Indeed, according to the survey from Royal Bank, Canadians are still eating out at restaurants in large numbers, still booking trips with travel seemingly unaffected by the increase in cost of borrowing, and spend way more on Valentine's Day jewelry than they did pre-pandemic, and only marginally less than they did the previous year. In fact, spending on discretionary goods have remained largely unaffected throughout Canada, with spending only marginally less than it was 1 year ago before the Bank of Canada raised rates by 425 basis points. So Canadians, at least a portion of them, still have a massive pool of savings that they can unleash into the economy and are still spending despite the major increase in the cost of borrowing. And while the Bank of Montreal notes that this excess savings could help cushion the blow of an extended downturn, meaning the impending recession, it is indicative of a problem for the Bank of Canada. The purpose of these rate hikes, the increase in the cost of borrowing, is to get people to slow down the spending. If prices go up and people won't pay or can't pay, then those prices have to go back down. But when prices go up and people with savings are able to pay up, then that puts a wrench in the Bank of Canada's plans. But the Bank of Canada has no real method of differentiating its policies to only affect some Canadians rather than others.
What did you say?
Fair enough, but the bank has no method of slowing down the spending of only those Canadians that have pent-up savings. And excess savings in normal times would be considered a good thing. In fact, if you'll remember, during the pandemic, Finance Minister Freeland made headlines as she looked for ideas on how to induce Canadians to unleash their pandemic savings into the economy. However, a 5.9% inflation rate has the Bank of Canada wanting to weaken the economy, and as it pushes up interest rates to try to make that happen, an increase in the cost of borrowing doesn't affect people who don't have to borrow to spend, which creates a real problem for the bank going forward. If people continue to spend, if businesses continue to raise prices and people are willing to pay up, then inflation could very well prove sticky for the foreseeable future. And the bank may very well have to go higher on interest rates to induce people with savings to slow down their spending habits, to get prices to drop, or at least to get them to slow the pace of their increases. As the Globe and Mail noted in a recent article, it will only be when the big spenders pull back on the spending that we'll see more modest increases in prices. So we definitely have two very different segments of the population right now. One that have seen its savings rate decrease substantially, and another that has over $300 billion in savings that have been largely unaffected by the rate hikes. This could very well prove to be a problem for the central bank moving forward, as its policies have differentiating effects on different portions of the population. And with those with excess savings being unaffected by an increased cost of borrowing, they are able to continue to spend, which, all things being equal, will continue to push up our inflation rate for the foreseeable future. With that said, we will continue to track Canada's inflation rate and the Bank of Canada's responses to that inflation rate on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.